Welcome to Objective 1 in Unit 5 of Accounting 3310. In this objective, we're going to look at identifying inventory and valuing it. Inventory is a large component of current assets for manufacturing and retailing companies. There are so many inventory transactions and inventory purchase prices vary so widely during a year that inventory valuation is challenging. Strategic and financial decisions determine the level of inventory that is held. How does inventory appear in financial statements? The objective is that students will be able to identify and value inventory. Let's take a look at the role of inventory in an operating cycle for a company. Let's start at the top here, although there could be various entry points. A company purchases merchandise that's going to be used for resale to customers. They then pay for the merchandise. That merchandise is then offered for sale to customers. It's sold to customers, and then one collects the payment from the customers. That payment then provides the funding to purchase additional merchandise and to continue through this cycle. The amount of time that it takes to go from purchasing merchandise to collecting from customers is the term of the operating cycle. For some businesses, this could be an exceedingly short time, measured in days, and for other companies, it could be weeks and months long. Inventory is often a plural word for the balance sheet of a manufacturing company. It's called inventories because these companies hold raw materials, work in process inventory, and finished goods inventory. In addition, there may be an inventory of supplies that are being used to provide services or that are being used to maintain and used with the equipment that's used in production. Inventory includes all of the goods for resale that are under the control of the company. So it includes not just the merchandise that's on the premises of the company, but it would include these sorts of goods also. Goods en route to the company where the shipping is FOB shipping point, where title transfers as soon as it is shipped. Goods shipped from the company FOB destination, where it still belongs to the company while it's en route to the customer. Goods on consignment at distributors' premises still belong to the company, and goods that are sold with buyback arrangements are still owned by the company until those buyback arrangements expire. What are the costs that are included in inventory? All of the costs to prepare goods for sale in a business, including raw materials, direct labor, freight in, and overhead allocation, which would be all of the period costs. Inventory value does not include selling costs such as advertising or commissions. It doesn't include extraordinary period costs such as abnormal spoilage of raw materials or finished goods. These are included in general and administrative costs. Normal waste or spoilage, either detected directly or through a physical count less than book inventory values, is part of cost of goods sold. That is, there's a certain amount of goods that never do make it into customers' hands. In a grocery store, we can see that most obviously because there are going to be some fruits and vegetables that spoil before they're sold. That's the normal spoilage. But if what happens is there's a hurricane that comes through and wipes out the grocery store, then we have abnormal spoilage because none of the inventory in that store is going to be available to be used to sell to customers. We also don't include in inventory an allocation of overhead that's abnormally high because of low production. That is, if we have a facility that has been reduced to just having one shift from having 3 shifts because of a change in demand and because of vacation scheduling, that facility is still going to have utilities and rent and so on and so forth. It really isn't fair to allocate the full amount of rent and utilities and so on and so forth to that 1/3 level of production. Unallocated overhead is a general and administrative expense. Inventory is not just the value that's paid to purchase those raw materials or to purchase the goods for resale in a retail setting. Sometimes there are amounts that reduce the price paid, and those indeed reduce the value of inventory. A purchase discount is a reduction in the purchase price because of early payment. Purchase allowances are reductions in purchase price because they're damages or other variances, although the company decides to keep the goods that were ordered. Purchase returns are merchandise that's returned to the vendor. Let's take a look at these terms. A purchase discount is a reduction in the price of merchandise due to early payment to suppliers. This is distinct from trade discounts, which is merely a way of describing the price of merchandise when volume or type of purchaser affects the offer price. Purchase discounts are written in this specific form, where the number that's at the beginning is the discount percentage, and after the slash is the number of days in the discount period. So 2/10 means that the purchaser receives a 2% discount. That is, they pay 98% of the purchase price if the purchaser pays within 10 days. Sometimes the following codes are used. N means net, as in N/10, which means that the net amount is due in 10 days. Net is a way of saying the entire amount is due in 10 days. EOM is a code meaning end of month, so 3/EOM means there's a 3% discount if the bill is paid by the end of the month. The reduced price actually paid for merchandise is the price that's reflected in the account of inventory. Let's take a look at an example. Merchandise is purchased for $1,000 on August 24th with terms of 210. What is the cost basis of the merchandise in the following instances? If the merchandise is paid for by September 2nd, then it's within the 10 days, so we expect that we will get that purchase discount and will record the merchandise at the lower price. If the merchandise is paid for on September 4th, we're outside of the 10-day window, and so the purchase discount would not apply. Purchase returns occur when merchandise is sent back to the supplier due to errors in delivery or quality control problems or just excess merchandise. The value of purchase returns must be subtracted out from the inventory account so that only merchandise actually available for sale is part of the value. Have you seen paperback books with no covers? Sometimes the supplier authorizes the disposing of merchandise instead of its physical return, while still making a return adjustment to the payable and receivable. Only the covers are returned to the publisher in order to document the return and justify the reduction of the payable receivable. Purchase allowances are decreases in the amount charged to purchasers because there's some defect in the merchandise, dents, wrong color, late arrival, etc. However, the purchaser keeps the merchandise and includes it in its selling process. Purchase allowances are granted after delivery, and accounting records must be adjusted to the lower price inherent in the decrease in the payable and receivable. Here's a T account for inventory that shows the entries that are made to the inventory account. There will be some beginning balance because no company is going to completely sell out and have absolutely no inventory at any point in time. We'll add the purchases to increase inventory and will decrease inventory when inventory is sold, which is called cost of goods sold. Let's take a look at these terms. Beginning inventory plus purchases during a period added together are called goods available for sale. two possible outcomes happen to goods available for sale. They are either sold and become part of cost of goods sold, or the company still has that merchandise in ending inventory. The physical count of ending inventory is required annually to be observed by auditors. That's one of the ways of being able to divide up the amount of goods available for sale. We can track that ending inventory, and then we know that the rest of the merchandise must have been sold. The inventory equation of cost of goods sold equals beginning inventory plus net purchases minus ending inventory provides a convenient way of calculating the expense of cost of goods sold. Ending inventory from the previous period is beginning inventory for this period. Net purchases means that we're not just counting all of the purchases, but we've adjusted it by adding in freight in and subtracting out purchase discounts, purchase allowances, and purchase returns. Ending inventory is typically tracked through a physical count. The following facts affect the inventory of a company. As you go through each of these items, can you calculate what the value of inventory will be? Let's say that the merchandise had a list price of $10,000 at the supplier with discount terms of $210. What if the company paid $200 to a third-party freight carrier to deliver to its warehouse? At delivery, $1,000 of merchandise was defective and returned, and the company received a 30% allowance on another $1,000 of merchandise that was damaged but still saleable. At the time of display in the store, trim was added to the merchandise that had a cost of $400 for the batch and required $100 of direct labor. Any overhead allocation was considered immaterial. ABC Company paid for the merchandise within the discount period. Take a look at all of those facts and circumstances, and let's see if you come up with the same value for inventory as I have. My answer is $9,226. The original $10,000 minus the purchase return, minus the purchase allowance, minus the purchase discount, plus the freight in, plus the raw materials, plus the direct labor. The relationship of inventory, purchases, and cost of goods sold is an important relationship to understand. Here's a series of 3 years of information on inventory in the operations of a company. Can you take a look at this and go through and calculate what each of the missing pieces of information are? First of all, net sales is sales less sales returns. We'll be talking more about sales in the next unit, in a unit coming up. But in the meantime, I think you probably remember that from your Principles of Financial Accounting course. Then we have a missing piece of information for purchases and for ending inventory. Remember that beginning inventory plus net purchases is equal to cost of goods sold plus ending inventory. So it appears here that we're missing information that we're going to need to have in order to come up with our total purchases. However, remember also that ending inventory in one period is beginning inventory in the next. So we can tell what ending inventory is because we have the next period's beginning inventory. As you look at the next 2007, think about what you need to calculate sales if you know sales returns and net sales. Likewise, when we're calculating ending inventory, we need to know beginning inventory, net purchases, and cost of goods sold for that. But here, cost of goods sold is missing. Well, we have got to know what sales are and gross profit to calculate cost of goods sold. Take some time to take a look and see if you understand all of these relationships and can come up with the figures. And then start this video again and see if your solution matches my solution. I've calculated here the values for net sales, ending inventory, and purchases in 2006. In 2007, sales, ending inventory, and cost of goods sold. And in 2008, sales returns, net sales, beginning inventory, and ending inventory. The calculations are shown on this next slide so that you can match up these formulas with the numbers that were given. If you have succeeded in valuing inventory and understanding the relationship of inventory within the context of sales and purchases, you're going to be ready to go on to the next objective in this unit. Thank you.